We have got insurance news all over the place. So I wanted to go over some news regarding California's FAIR Act and other auto insurance news that has been popping up, and articles about insurance increases in 2024 and beyond. So let's get into it. So the first on the list here is the California FAIR Plan can pass extreme costs on to customers, Department of Insurance says. So here's the article. This is from ABC 10 News. The California Department of Insurance is allowing the FAIR Plan to charge insurance companies who can charge customers to recoup costs after certain major wildfires. So in short, the FAIR Act would demand that any insurance company providing insurance in the state of California for homeowners insurance would have to pay to play, and it would go into this fund, this California fund. The California Department of Insurance said the state's insurer of last resort, the FAIR Plan, can pass costs it can't afford in the wake of a major wildfire onto insurance companies, which can recoup some or all of that money from policyholders. So in short, any of these tax increases or cost increases or demands that the government has for the insurance companies to pay or take on additional risk does get passed on to the customer. Will always happen that way. The department announced the change back in late July, and on Tuesday issued a bulletin to insurance companies offering more details and clarification. In a major disaster, the FAIR Plan will pay out all of its retained earnings, reinsurance, and other backstop funds first. Insurance companies and consumers would share any additional costs up to $2 billion, and the insurance commissioner must approve any assessment on policyholders before they pay anything. The CDI said in a FAQ page, while the FAIR Plan hasn't had a solvency crisis in 30 years, we are taking no chances. The changes will strengthen the FAIR Plan's financial reserves and backstops so it can fully and expeditiously pay all future claims from customers. Before these changes, insurance companies would pass along 100% of the costs to Californians in an extreme worst case scenario loss. This comes amid a crisis of affordability and availability in California's homeowners insurance market. So we're seeing insurance companies pull out of markets left and right, not only in California, but we're also have had this happen in Louisiana and Florida, any area where there's a major disaster. And it looks like it's also going to be happening here in Canada, because Canada's wildfires, which reminds me, because that's one of the issues that California has had in the last 5-10 years, is unprecedented wildfires. As a result, more people are finding the sold call insurer of last resort, the bare bones, costly California Care Plan, as their only resort. So the California FAIR Plan is there for people who are being denied insurance from private insurance companies. Though its existence is mandated by the state, the FAIR Plan's pool of money to pay out claims comes from the policies itself, not from the taxpayers. The FAIR Plan has ballooned in recent years, and insurance experts say it was never meant to be this big. The numbers of policies has nearly tripled since 2019, going from 154,494 residential policies to 4,601 commercial policies in September of 2019 to 400 8,432 individual policies and 11,026 policies of commercial policies, respectively, in June of 2024. So again, going from about $150 individual policies for this homeowners fair plan up to over 400,000 policies because of these wildfires. Insurance companies have issued non-renewals, and individuals have no other choice but to go onto this fair plan, because when you have a mortgage on a home, those mortgage companies require you to have policies that will cover them and you in case of a loss. That means its financial risk exposure is bloated as well, going from $50 billion in 2018 to nearly $393 billion as of this June in 2024. This has led one lawmaker to ask Fair Plan President Victoria Roach earlier this year how much cash on hand the Fair Plan has.
How much cash on hand do you have?
Surplus is about $200 million. Cash on hand is somewhere in the neighborhood of $700 million.
So a tiny percentage of what your exposure is.
Roach said the Fair Plan had purchased about $2.5 billion in reinsurance, essentially insurance for insurance companies, and explained why that's not enough. So one of the issues that comes up in insurance is when there's a trend. So trend is your friend in any mathematical situation. So they see this 4x increase, and the actuaries have to assume that those trends will continue. And they have to assume that the risk will go up another 4 times or at the same trajectory as it has over the last 5 years. So when they do the mathematical equations and bring that forward, it could basically, if the trend continues, blow up the plan. And they are extremely concerned about that. CDI said even with the major wildfires the state has seen since 2017, the Fair Plan has not had a disaster it hasn't been able to afford since 1994. I don't know about you, but that's not very reassuring. So it's only been, 25, 30 years since we haven't been able to pay out, I know insurance companies who have never had a claims issue, right? On Tuesday, a bulletin from California Department of Insurance, which regulates how much a company can charge customers. So what bothers me about this is if this were any other situation where an insurance company wasn't paying out a claim or didn't have enough reinsurance or money reserves to meet insurance company standards in a specific state, they would be kicked out. Your head would spin. It would happen so fast. But because it's a government, anyway. Okay, so in the highly unlikely event that catastrophic losses render the Fair Plan unable to pay operating expenses, because that's the most important part, not the claims, and policyholder claims, because it does not have sufficient retained earnings, reinsurance, and or proceeds from catastrophe bonds, if sold, the Fair Plan may request the insurance commissioner's approval to assess each member's insurance company its fair share if necessary to pay the plan's operating expenses and policyholder claims. In other words, if the Fair Plan can't pay its claims, it can ask for that money from insurance companies doing business in California. Which can then, with the permission of CDI, turn around and recoup some or all of those costs from their policyholders. So again, it just comes down to consumers paying more. Consumers paying more, blaming the insurance companies for this. Believe me, I'm not sitting here, a huge advocate of insurance companies. I'm not here to tell you they're all great and acting in your best interest. They inherently act in the best interest of their shareholders and themselves, but they are mathematicians. Insurance is math, and they look at the risk and they look at what they are on the hook for and what's money in, money out, what's the loss ratio, how much are they losing on each policy, how much are they making on each policy, and if they're making zero or they're getting a loss, they are very unlikely to renew the plans or leave the market altogether. And this is too much risk for many of the insurance companies out there, saying that if the FAIR Act cannot pay its claims, if the government plan that they set up that they're saying is so great can't pay these claims, it can ask for the money from insurance companies doing business in California. So therefore, doing business in California is adding to their bottom line risk, which can then, with permission of CDI, turn around. So they have to ask for permission from the California Department of Insurance if they can even increase their premiums. Okay. So California is telling them you have to pay these claims, or requiring you to pay these claims. And by the way, when you turn around and ask your customers to pay more money, we're telling you that you can't. Or if the cost is 30%, we're asking you to only increase it 10%. So they can turn around and recoup some or all of the costs from their policyholders. We're like one bad fire season away from complete insolvency, is what it feels like to me, said Wood. We are one event away from a large assessment. There's no other way to say it, because we don't have the money on hand and we have a lot of exposure out there, a really unlimited amount of exposure. I'm not really sure how this could be calculated. Of course, it could be calculated on a range. Roach replied, "We're a not-for-profit. We don't have a lot of money sitting around. Our rates are not where they need to be. And so if we have a major event, we're going to look to the voluntary market, who is already in a precarious situation. And we're going to look to them to help us cover our losses. The more we grow, the more we expand, the more that becomes a reality." Insurance expert Carl Sussman of Sussman Insurance Agency told ABC 10, "There are two ways to look at the CDI allowing the FAIR Plan to pass assessments along to customers."
Bad side is that there's the potential. There's always the potential, right? The good side is now we know if you're with the FAIR Plan, you do not have to worry about your claim being paid, because there's all of this money that's going to come into it first.
A year ago, California Insurance Commissioner Ricardo Lara unveiled his sustainable insurance strategy. Solutions to insurance crisis he plans on having in place by the end of 2024. He hopes it will stabilize the market, bring more companies back to the state, and take some of the burden off of the FAIR Plan. And that's really the issue, is they're getting severe adverse selection. In insurance, there is this issue, and this happens to many plans, is adverse selection. So when a group of people come together and start a new plan, whether that's health insurance or, in this case, homeowners insurance, and they all come together, they build their own plan, let's say, and start out with 100 people. And let's say all of those 100 people, 90% of them have good risk. They're in an area that isn't really a fire hazard, a flood hazard, all of those hazards. So the rates aren't too bad, or perhaps they're even saving money the first year. And the next year, because the market changes or changes happen over time, perhaps the people that are the lowest risk, other insurance companies entice them away. Those people with lower risks may be enticed away onto another plan, and now you have 80% good risk and 20% bad risk. Then years go on some more, and those with good risk leave the plan, and by the time as the rates continue to increase because the plan is starting to have adverse selection, or the percentage of good risk is leaving, the trend is that it's leaving and the bad risk is staying in the plan. At the end of it, what ends up happening is the pie of participants is high risk claimants, and all the good risk claimants have left. Then those good risk claimants tend to offset the cost for the bad risk. So the insurance company is forced to continue to raise the rates year over year. And it's not surprising to me that this happened to this plan, because that's literally what the plan was set up for, is to help those who were bad risk that the insurance companies didn't want to take on. So that's really what has happened here. Essentially, it is a computer algorithm that would allow companies to better predict and price where wildfire risk is the highest. Currently, companies can only use the past 20 years worth of data. In exchange for that tool, however, the CDI is requiring insurance companies to write more policies in wildfire-prone areas, including taking people off the FAIR plan and bringing them back to the private market. The insurance commissioner has also promised faster rate approvals. The system for getting rate hikes approved has slowed down over the decades since the legislation created the process of Prop 103, passed some 30 years ago now. Now, a rate increase request can take well over a year to get approved for a myriad of reasons. Companies say they can't keep up with the rising cost of doing business. So this is on the commercial side. A more efficient process, the department hopes, will make California more attractive for doing business once again. So they're trying to bring insurance companies back to California to create more of a competitive environment, because we all know the more competition there is in a market, the better pricing we get for the consumer. And California has certainly gone the wrong way on this. We know with all of these guidelines coming out that the carriers, when they re-enter the market, the FAIR plan business will be the first business they start taking, Sussman said. Sussman hopes to see change sometime early next year, and in the meantime, homeowners remain in an unsustainable insurance market.
This is like people can't afford to live.
Not only are we in a recession, in my opinion, but we are also hitting a level of inflation that has not been seen for decades. The FAIR plan says the areas with the highest financial risk for them include Nevada City, Grass Valley, and Truck E. The historic Nevada County Gold Rush area town of Washington, nestled in the Tahoe National Forest, is among the areas hardest hit by the insurance crisis and affordability and availability crisis. Charity Jackson, who owns the Washington Hotel, has seen both her homeowners and commercial insurance for her hotel go from regular market to the FAIR plan after getting a non-renewal. She said, "My homeowners policy included her liability, and it used to be $1,300 a year, and sure, it's going up and up and up, but I think now just my FAIR plan is close to $5,000 for my house. That's a huge amount of money, especially if you are on a fixed income, low income, disabled, senior, etc." Insurance premiums for her and nearly everyone she knows in the town are becoming unaffordable, she said. "It's going to continue to happen, which is scary," Jackson said. "I mean, I don't know how I'm going to make it work right now." If you have any questions, please feel free to click the link down below. I am available. Make a comment, like, subscribe if you want to get notifications on any new news videos that I have. And thank you for hanging out until the end. We'll see you next time.